Welcome to the Gray Report. I'm your host, Spencer Gray. And if you are a multifamily investor, an aspiring investor, an industry insider, or you just like the idea of creating passive income and generational wealth through commercial real estate and multifamily investments, well, you are in the right place here at the Gray Report, doing another weekly roundup of everything that happened in the multifamily industry, real estate, and the economy. A lot of great topics, a lot of things moving as they do typically every week. But first, if you are not subscribed to the Gray Capital YouTube channel, well, do us a huge favor. We'd really appreciate it. Go ahead and subscribe to this channel right now. Give this video a like. And if you agree, disagree, want to have a comment, please, love to hear what you think. So add your comment below. But also, this episode is sponsored by GrayReport.com, the premier multifamily intelligence aggregator, bringing you all of the latest research reports, news articles, opinions, but also podcasts and videos from the multifamily industry, commercial real estate in general, and just the economy at large. So it is the premier resource for real estate investors. Go check it out, GrayReport.com. That's www.GrayReport.com. And then again, if you'd like to take the next step and learn about how you can start investing in multifamily real estate, we'll hop on over to GrayCapitalLLC.com. And if you'd like, you can join the Gray Capital Investment Club. All right, without further ado, let's get into the newsletter. We're going to be bringing Matt Bosnagel, the Director of Communications and Marketing at Gray Capital. Matt, pleasure having you on the show again. How are things going?
They're going pretty well. Everything is certainly humming along. I'm looking forward to another great week.
Absolutely. All right, let's get right into the report. Markets ready for summer. 4th of July weekend is coming up next week. Think people are looking pretty optimistic. We are off the last week of the large Federal Open Market Committee conference, and really Jerome Powell speaking, kind of giving us an update on the economy. So we're getting off the heels from that. But what's going on, Matt? What's the theme for today's newsletter?
Yeah, markets are humming and they want to grow. Growing's better than shrinking. Who wants to shrink? Inflation, not much worry about it now. Following last week's comments, there was a little bit of an adjustment later in the week, and they were a little worried about inflation. And then on Tuesday of this week, Jerome Powell kind of softened a little bit and said that you don't need to worry so much. He downplayed inflation fears, called it, reaffirmed really his statements that it was transitory, and really the activity in the U.S. stock markets continues unabated. The stock market, especially technology stocks, they took a little dip last week, but then they've really come up after these fears. We're not scared anymore. Jerome Powell has told us not to be scared of inflation, so we're not going to be scared of inflation. Everything seems ready to grow. Yeah,
it's amazing. Everyone's kind of memories are pretty short-lived, and it's amazing how quickly people are able to switch the narrative. Inflation, non-inflation, and it's kind of similar to what we've been saying for a long time. There's elevated levels of inflation. It's probably not going to be hyperinflation. It's not going to be crazy. It's probably going to be a little transitory, but not a quick blip, maybe more of like a little pulse, a little ramp up, but it's nothing to get too concerned about. And it seems like the Fed, they are really targeting maximizing employment and, looking for some sort of price stability, which I think they're kind of missing out on a little bit, but they'd rather see everybody have a job. So that means lower rates for longer, keep pumping the economy. All right, let's get into snapshots of rates and markets. What is going on? So let's look at it. First year, the 10-year Treasury yield. We've been dipping below that 1.5% mark, coming in at 1.48%. The 30-day LIBOR coming up 0.09%. SOFR is just ticked up slightly, a little bit. Now we're up at 0.05%. Again, so many loans now, they're switching over being indexed to SOFR rather than 30-day LIBOR if you're not being indexed to the 10-year Treasury. Looking at the spread, it's narrowed between the 10-year Treasury and the 2-year spread. That is right now 124 basis points before the 10-year and the 2-year. HUD 223F loans, very attractive rates right now, 2.3%. HUD 221D4, again, these are for new constructions, 40-year term, 4-year amortization, coming in around 3%. And Fannie Mae and Freddie Mac, also they're relatively low. Again, around a 3% range, 3.05. Again, that can change depending on the sponsor, the market, the deal, your term, a lot of different factors for that rate to be variable. And then the S&P 500, as Matt has said, has been doing quite well. Stock market has been on, it's been on a run to say the least. So looking at the S&P 500, we're essentially right at all-time highs. It's been not a straight shot, but it's been a pretty steady move up since last March.
Yeah, just a quick note. It was interesting. I was talking about this shift from value to growth, and it seems like and that was last week when it seemed like inflation was going to figure more in people's minds, but it has gone right back into growth. Maybe not in some areas, which I'm sure you're going to mention in just a second here.
So yeah, I think we had a rotation. We're rotating back in. Again, these cycles are going relatively quick depending on sentiment. But let's look at the iShares Residential ETF, RES. Again, that tracks residential REITs in the apartment sector, coming in at $84.31. Spot price for gold, $1,776 an ounce. Perfect for the 4th of July weekend coming up. The New York SE Steel Index, 1743. That's come down off its highs. In lumber, we're tracking at 879 on the random length futures. That is way down from where it was several weeks ago. Lumber has really come back from the stratosphere where it was, and we've discussed so many times on this show. Crude oil, it's been moving up. And again, I think crude oil could still be an argument for at least some elevated price levels, some levels of inflation. Crude oil at $73. Bitcoin, crypto's had a rough month or so. Bitcoin's 32,000 and Ethereum 1,889. A lot of turbulence in the crypto markets as of recent. So, all right, let's get into some of the articles on the Gray Report newsletter. Again, you'd receive all of these articles, all of these research reports directly to your inbox just by signing up for the Gray Report newsletter. So if you want to hop on over to graycapitalllc.com/newsletter, you'll get this in your email every Thursday morning at 8:30. And if you want to stay up to date in between then, just bookmark grayreport.com. Okay, let's get into it. President Biden to replace leader of Fannie Mae and Freddie Mac after high courts ruling. The Supreme Court of the United States made a 7-2 ruling that these agencies, Fannie Mae and Freddie Mac, they got to be more accountable to the Biden administration, kind of reversing the efforts of Republicans in the Trump administration to decouple Fannie Mae and Freddie Mac away from government control and privatize it. Mark Calabria was put in by the Trump administration really to kind of make a plan to privatize Fannie and Freddie. And the Biden administration basically said, that's not what we want to do. We want to keep it under government control. And Mark, sorry, thanks, but no thanks. And it sounds like essentially the Supreme Court decision basically outlined that the president can remove the head of the agencies, basically not just for cause, but for any reason. And so he did. Matt, what's your take? What's going on?
Yeah, I kind of, I think you covered the bulk of it. And we had discussed this just a second ago here, and I don't expect any earth-shattering changes to happen in the wake of this decision. And I don't think that policy-wise, we're going to see any drastic changes. This case began long before Biden's administration. And I think the decision is more of an occasion to start paying attention to what Fannie Mae and Freddie Mac are saying and doing. But I don't think that there's going to be any action right away. Yeah. We'll see it coming, but I do think it's interesting, and it plays into Biden's overall push. There, he does have housing as part of his agenda, so it's something that should be on people's radar.
I agree. I think that the news is really no news. That the biggest change and uncertainty would have come from agencies being privatized, and so now it's kind of just business as usual. So, all right, let's look at we've talked about again on the same topic of the Biden administration making changes to the tax code, and the 1031, the like-kind exchange, has been discussed as being on the chopping block, more likely to add a cap of how much proceeds you can really kind of roll in, kind of capping that at around, they've talked about $500,000, which really would eliminate the bulk of the need for a lot of 1031 exchanges really getting rid of that great advantage in real estate itself. So we've got a couple articles in the Gray Report kind of discussing it. Matt, this article from wealthmanagement.com discusses UPREITs as an alternative to 1031 exchanges. Do you think UPREITs are a valuable or a viable alternative to 1031 exchanges? And then I guess maybe let's also discuss just using all of the accelerated depreciation and passive losses that you can get in the first year of investing or buying a commercial piece of commercial real estate, those types of losses and tax savings versus 1031 exchanges, UPREITs, and the like.
I think that I think ultimately I'm not really worried about the movement from the 1031s. I think that there are aspects of 1031s that can't be that you can't get with the alternatives with UPREITs. But ultimately, I don't think that even though it's a clear target by the Biden administration, more than the changes in Freddie Mae and Fannie Mac. I want to point to the Globe Street article that notes that eliminating or curbing the 1031 exchange would slow economic activity and suppress investment far in excess of the 2 billion, or really slightly less than 2 billion that it's projected to generate. 15% of real estate investments are tied up in 1031s. And I don't think it's likely that Congress will cooperate with the Biden administration, but I do think it is worth looking at these alternatives like UPREITs and other things. But it's not going to be an easy switch. Not everyone's going to know about these alternatives, and there's going to be a very bumpy road if they make any significant changes. Again, I think that and the article on Globe Street talks about, he's very pro 1031. He doesn't say it's not a loophole, it's a deferment, and that's true. You're not saying I'm not going to pay taxes. You're just going to say I'm going to pay them later. But this is a system
until you die and you get passed on your kids with a stepped up basis. That's the idea, unless they get rid of the stepped up basis. That would be the 1-2 punch.
Yes, I would lump both of the agency action and the 1031 action together as something that you should pay attention to, but something that is not on the near term horizon. But you definitely need to keep looking at it, keep looking at those alternatives like UPREITs, and start making some maybe a little bit of plans, not vague plans, but you just have them in your back pocket so that you know something to do if action starts to be taken. Maybe it won't be.
I think you need to have understanding of the options out there. A lot of people didn't even use 1031 exchanges because they're they can be burdensome, and you've got a clock that you've got to identify properties within a certain time frame, and they can kind of force some people to make maybe a bad decision. So that's why it's only what they use 15-20% of transaction. That is a lot of transactions. So it would be disruptive to the market. The only pushback is on the 8 back to the Fannie and Freddie stuff. To me, it's almost a message of like, if you were paying attention, now you don't need to pay attention, because they're saying anything that would have changed is not going to happen. It's going to be status quo going forward, but it's
status quo of government control.
They're not like they don't give up control too easily. It seems like, so not exactly too surprising. All right, so we got more news on the eviction moratorium. The CDC is likely to extend the eviction moratorium ahead of the June 30th expiration. And man, are we living in Groundhog's Day? I feel like every time this thing's getting ready to expire, it's a doom and gloom eviction moratorium. 6 million renters are going to face eviction, and so we have to extend it because of the coronavirus still. But Matt, what I wanted to ask you about this is the issue. It seems like is we've passed billions of dollars in rental assistance to help individuals who have a hard time pay the rent to be able to pay their rent. If we have that, then why do we need an eviction moratorium? Part of the reason it seems that rental aid isn't getting out. Why isn't it getting out? And why do we need both? Why do we need rental assistance and eviction moratoriums? It seems like this is kind of just screwing up the market.
Yeah, in my opinion, they shouldn't have that moratorium without some form of rental assistance that goes back to that lets renters come even at the end. It's a little bit almost, I don't want to say manipulative or exploitative, but I've been on the other end of this with student loans. You can defer it. That doesn't mean you won't be paying it at the end. I think that far more attention should be paid to getting rent relief. I think California may be doing some form of rent relief. There's
Well,
been
there's
discussions
national
about
rent relief. I mean, I think there's like $4
there's
billion,
$45 billion of rent.
$45
Yeah.
billion that was passed in federal rent relief. It says there's 340 programs that have been launched by states, municipalities to distribute the funds, but only a fraction of the money has reached renters as of late last month. And we've seen this, in our own portfolio and our own properties, and we've seen some individuals being able to get rental relief, some haven't. The problem, it seems that it's a patchwork. It's not
Yep.
a kind of clear set program. And here's the website. Every county, every municipality seems to be handling it a little bit differently. Every state, but yeah, if the relief is there, what's the point of an eviction moratorium? Because it seems like if the relief is available, there shouldn't be any excuse unless you're just not wanting to pay because you don't want to pay. And then why shouldn't you be able to evict someone?
And
In
what
those
I'm afraid is going
circumstances.
to happen is because, all of this kind of red tape about who gets what rent relief, the people that need it are not going to be able to navigate it as
Mhm.
well as people that may not need it. And ultimately, I think it may go to landlords to kind of sort this out and help tenants to kind of break even and get this rent relief. So this is going to be a little bit of a mess, and unfortunately, one that's not going to be fixed anytime soon.
Yeah, I think it would behoove most landlords to be working with their residents, making sure that they do some of that research up front to
Yeah,
identify if you're having an issue. Here are the programs, because if they're out there, why wouldn't you want to help a resident who's having trouble qualify for them? I mean, if
yeah,
they're out
yeah.
there, the money's been spent, the check's been written. Go out there and get it. You've probably paid taxes into that relief fund, so might as well kind of come back at some point. So, but very frustrating. And we've done a whole video on the eviction moratorium on how actually the more evictions mean that you're actually in a better market over the past year because the market is actually functioning and working versus some markets where there's no evictions, but that means you could have somebody just staying in your apartment for an indefinite period of time without paying. No good. Hard to operate a business under those conditions. All right, Matt, Newmark, they put out a report, the Newmark Opportunity Index, identifying commercial real estate opportunities and challenges in major U.S. markets. Now, this is a report really only over the major markets in the U.S. So really, there's a handful of secondary markets, but a lot of the markets that we invest in aren't in this report. Still worth looking into. What were your major takeaways? They cover all asset classes. But what was your major takeaways in general?
I liked this report, not because, so it is major markets, and it's not going to reveal the real diamonds in the rough sometimes that we find, the under noticed,
Yeah, it's okay though.
but that's okay. And I liked how it showed how there are some markets where office and retail, these things that are thought to be kind of suppressed lately, are doing quite well. I pulled out Tampa as a real strong performer.
Mm-hmm.
I don't, I
Absolutely.
hear a lot about Sunbelt, and but Tampa was solid ranks in industrial, office, retail, hospitality, and really multifamily too. That may be a real star,
Yeah,
and it's
yeah,
interesting.
yeah.
Yeah,
I agree. Tampa's been a strong market, and again, it's tracking that Sunbelt story of just migration, and Tampa seems to attract more young people than many other markets in Florida. And it's one of the older cities in Florida, and I don't know. So I think that younger generation, they're more likely to be renters. So yeah, we've
yeah.
been kind of tracking Tampa for quite some time as a very strong market. But then yeah, it's interesting, just again, because we don't focus on the gateway markets too often, kind of seeing what is going on, because real estate, it's hyper local, but at the same time, trends that can start in one market can trend to other markets. And a lot of times that we see in these major markets, those trends kind of pass down. So you kind of sometimes a little bit of crystal ball
Yeah,
sometimes.
looking at all these measured up against each other, it really gave me a sense that things are kind of started to settle down to normalcy. It didn't really emphasize the huge struggles in one sector over another. So And I, there are still sectors that are doing better than others, but it really, yeah, again, to reemphasize, this is a period of growth, and I think that that's what we can expect in the CRE market.
Yep. Another period of growth, a little bit of base effect, but really getting beyond that is a performance surge in luxury apartments. Greg Willett from RealPage did this article, and Greg puts out a lot of really good, insightful information. Looking at all of RealPage's data they have coming in from apartment communities across the United States. They're seeing a big jump in Class A apartments. You can see on this graph right here, there's a understandable drop during 2020. But we are, way off that and well above it now for rent increases, annual charges in effective asking rent for new resident leases and Class A assets. And the time to lease up those units, the days that are vacant between leases is dropping significantly. I think this probably is because people are finally deciding, okay, I'm going to get out. I've been in my place now for 2 years because last year I didn't want to move. All right, I want to move, and maybe I'm making a little bit more money, but you know what? I want a nicer place. I want a place with a nice pool. I want a place with a nice gym, that if I have to stay in one place, I can. And I want all the amenities. And so you can see in this chart, that time to lease has gone down. And in a sense that it looks like it's going straight down, but in a sense, this tracks the seasonality of the leasing season. You see leasing activity increase during the late spring, early summer months. That's exactly what we see, and then slows down during the fall and winter. So I imagine you will see the same thing, but this time frame where it looks like in past years it was closer to 20 days, we're just under that 20-day mark. So definitely a decent demand for sure.
Yeah, I wonder how much of this demand too is from the hot housing market. If you can't buy a house,
I think that's a great, really good point. You're probably right, and we've experienced that at some of our Class A properties. Is that some people sold their house and are like, I don't know where to go, but I want a nice place. Or some people are building or renovating a house. It's going to take 6 months to a year to do that, and they want to live in a nice place. So that's a really good point. Okay, so. But this is on a similar topic, not exactly related, but I think it kind of cuts in the same vein. How is an increase in construction costs affecting commercial development? We've talked about lumber. We've talked about the producer price index. Shot up. Data came out last week. It begs the question: can you still afford to build new construction? Matt, what do you think?
And we were talking about this. Just before this recording, how construction costs, and I may be stealing your figure, so I apologize.
I teed you up. It's all right.
Yeah, that's great. Thanks. Supplies and materials are getting more available with, like lumber is getting more available. But there are steel, timber, PVC pipe, plumbing supplies, computer chips. All of these have supply issues. But they are expected to wane in the latter part of the year. And construction costs are about 4% of the value of properties. And the value of properties themselves are up way more than 4% since the supply crunch. So it's important to know that materials is just one part of the cost of a building. Obviously, labor is another part, but these are still discrete materials. There are some materials that are available, and it hasn't really doubled the price of new construction like maybe.
Yeah. Well, and just to clarify, and this is Chicago as an example. Over the past 12 months, there's been 4.3% of construction cost increases. Well, that's certainly above 2% inflation. They're also saying that, specifically talking about industrial assets, leases have increased 16.5% over the past 5 years. So that's we're not going to see the same rate of growth in terms of construction costs every single year, but just like the industrial rental rates. That's a little bit under that. I think, average that over, 5 years is close to 3% a year. But that doesn't include the cap rate compression that's gone on in these assets as well. That's really driven the price up. So if you've got rental rates increasing 3%, you're going to have your asset valuation increase significantly more. In some cases, these properties have increased by 20, 30, even 50% over the past couple of years.
Yeah.
And so where if if you could sell a multifamily project for, let's call it $160,000. Oh, let's just use $200,000 a door, to keep things, nice and even. Maybe it would have cost, $150,000 per unit to, build that, to sell then at $200,000 per unit. Well, now maybe it's going to cost, 165, maybe 175 to build, but maybe you can sell it for 230. So,
Yeah.
I think it still pencils if the sales price, what you were building to, decline, and we had cap rate expansion, and we also had material costs rising. That would certainly be unfortunate, but that's just not what is. That's just not what is happening. So there's a lot of talk of construction slowing down, people delaying projects, and I'm sure that is taking place. And I anecdotally heard about a project that's being delayed for a year here in Indianapolis. But I'm wondering if that decision was made like 3 weeks ago when they were pricing everything out and lumber and steel and everything was up so much. But again, a 50% price increase in lumber only translates to a 4.3% overall cost of construction. So people see these 50% increase, 60% increase, 300% increase, and they're like, that is insane. But it's there's a lot of inputs into construction. It's not just the wood or the steel. So
yeah, and I think you made a good point that I just want to touch on really quick is the long term nature of some of these projects and some of the decisions that are made.
Mm-hmm.
You may see a spike or a dip in steel or lumber, but ultimately that price it's going to take a little while for that to trickle through the system. So
yeah,
I think things will wane by the end of the year. It's not going to happen overnight.
Mm-hmm. Good point. Okay, so now let's just take a quick look at a Marcus and Millichap report, what the ongoing recovery means for real estate investors. And a lot of this was talking about retail and commercial real estate. But Matt, what is the, this is a video, but get us into it. Yeah.
It was a short video from Marcus and Millichap, and I really liked it because of there was a couple of charts that really showed like, wow, this could be back to normal. The chart that you see right now is the retail sales, that they're back above pre-pandemic levels. It really dipped, and now it's coming back. You can see where the pent-up demand kind of came, and then it's dipped a little in May, but it's still above where we want to be. And I think that things are, let's cross our fingers, but this is the theme for today. We're growing. Let's not shrink. Things are going great.
Yeah. And then this is another interesting chart, the retail sales at grocery stores versus eating out. Grocery dropped down, people weren't going out. And I find it fascinating that, and I'm colorblind, so it's hard for me to sometimes tell the difference between these lines, but bars and restaurants obviously dropped off last March, but have recovered. And they're finally back up above kind of grocery sales levels. Yeah. That's definitely great to see for certain. Okay, and then there was a really interesting report, I think, from Yardy Matrix, relationship between pandemic rent growth and educational attainment. We look at the level of education a lot of times in demographic surveys, but we don't always give it that much weight. Although I think maybe we should. Matt, what are the key takeaways from this report?
So I think this is interesting, especially in light of that earlier report from RealPage that talked about Class A performance. You would think that more educated people, they're paying more for apartments. If Class A's are doing better, then maybe they were paying more. But this one suggests that the more education you find, the more, this is through the pandemic, the more educated you are, if you have a bachelor's degree or better, you are more likely to have had a higher rent decrease than if you were less educated. And the reason why is because if you have a bachelor's degree, you're more likely to have remote work. If you're a remote worker, you're more likely to be able to move around and shop around and find a better deal. If you don't have a remote work, you're kind of shackled to your apartment. You're a little bit more of a captive audience.
Yeah, you're more
don't
mobile.
Have that power to shop around and get a better deal.
Yeah, that's interesting. And it makes sense. If you can work anywhere, then you've got options. You know, you may choose to live in a nice, expensive place, but you don't have to live in an area where it's going to be quick to commute. Versus if you are, an essential worker, you have to show up to your job. You have to factor that commute time, and you're just more tied to um, that physical location. So I think that makes a lot of sense. Excellent. All right, Matt. Again, this was an excellent edition of the Gray Report newsletter. Just to recap, if you would like to receive these newsletters in your inbox every Thursday morning at 8:30 in the morning, hop on over to graycapitalllc.com/newsletter to sign up for the Gray Report newsletter. But then stay up to date every single day. Just stay on grayreport.com, have it bookmarked up in your browser so you can check it when you want to see what's going on in the multifamily industry, real estate, and the economy. And then the last step, if you are interested in learning more about investing in multifamily apartments, learn more about what Gray Capital is all about, you can hop on over to graycapitalllc.com to sign up for the Gray Capital Investment Club. Check out our track record, check out the team. We've got ebooks, we've got all kinds of PDFs and resources. And really, really appreciate that. And if you appreciate this video, you got something out of it, again, we really appreciate if you gave it a like, subscribe to the channel, and again, agree, disagree, let us know in the comments below. All right, Matt, I really appreciate having on the show once again. Love the report. It's great stuff. We keep getting so much good feedback from it. Thanks again. I'm your host, Spencer Gray, president of Gray Capital. Stick around for next week's episode of the Gray Report Newsletter Recap. And until then, we'll see you later.